Is Google still the unshakable giant of technology, or is it now facing real risks in the age of artificial intelligence? With a market cap in the trillions and AI reshaping the industry, the question isn't just about dominance, it's about survival in a rapidly evolving digital era. Alphabet Incorporated, founded in 2015 as the parent company of Google, was created to give greater transparency and flexibility to its diverse operations. At its core, Alphabet is built on three pillars: Google Services, which include Search, YouTube, Android, and advertising; Google Cloud, a rapidly growing division providing infrastructure, data, and AI solutions; and Other Bets, a portfolio of experimental ventures such as Waymo and Verily. Together, these segments reflect Alphabet's strategy of balancing its dominant advertising engine with long-term innovation across cloud computing and emerging technologies. Today, Alphabet stands as the world's second most valuable company, with a market capitalization of nearly $4.6 trillion, just behind Apple and ahead of Microsoft and Amazon. Its dominance is anchored in search and advertising, but the real momentum now comes from AI and cloud computing. Rivals like Microsoft and Amazon are pushing hard into AI and cloud, yet Alphabet responds with massive investments in infrastructure, custom AI chips, and strategic partnerships, such as integrating Gemini into Apple's ecosystem. This combination of scale, innovation, and diversification allows Alphabet to defend its commanding position, even as regulatory pressure and rising competition test its resilience. Financially, Alphabet's Q1 2026 results shattered expectations. Revenue climbed to $109.9 billion, up 22% year-over-year, while net income surged 81% to $62.6 billion. Earnings per share came in at $5.11, far above consensus estimates. The standout performer was Google Cloud, which grew 63% to $20 billion, supported by explosive demand for AI solutions and a backlog that nearly doubled to $462 billion. Subscription services also expanded to 350 million paid users, while Gemini AI adoption accelerated across enterprise clients. Yet, this growth comes at a cost. Capital expenditures reached $35.7 billion in the quarter, with full-year spending projected at up to $190 billion, underscoring both the scale of opportunity and the risks of overextension. Alphabet's Q1 2026 earnings release stunned the market. With revenue up 22% and EPS more than doubling expectations, investors immediately rewarded the stock. Shares opened over 3% higher the next day. The surge was driven by explosive growth in Google Cloud, a backlog that nearly doubled, and subscription expansion to 350 million users. For investors, the message was clear: Alphabet's AI-first strategy is delivering real results. Yet, the rally was tempered by concerns over massive capital spending, reminding the market that growth comes with risks. Now we are looking at a small portion of Alphabet's financial ratios for fiscal years 2025 and 2024. In fiscal year 2025, Alphabet recorded a gross margin of 59.65%, meaning that for every dollar of revenue, nearly 60 cents remained after covering the cost of goods sold. This reflects stronger profitability compared to 58.2% in 2024, showing improved efficiency in its core operations. Return on invested capital stood at 31.42% in 2025, up from 29.16% the year before. This indicates Alphabet generated over 30 cents of profit for every dollar invested, highlighting superior capital allocation and rising returns for shareholders. Free cash flow margin came in at 18.03% in 2025, slightly lower than 23.19% in 2024. While still healthy, This decline suggests higher spending on infrastructure and AI investments, which reduced the proportion of cash available relative to revenue. Finally, interest coverage surged to 67 times in 2025, compared to 48 times in 2024. This means Alphabet could pay its interest obligations dozens of times over, underscoring extraordinary financial strength and minimal debt risk. Looking ahead, Alphabet's future is supported by several powerful drivers. The company's leadership in artificial intelligence through Gemini and its breakthrough in efficiency with TurboQuant are reshaping how AI can be deployed at scale. Google Cloud continues to accelerate, with demand for infrastructure and enterprise solutions expanding rapidly, while custom chips such as Ironwood and TPU strengthen Alphabet's technological edge and reduce reliance on external suppliers. Subscription services, including YouTube Premium, Google One, and Gemini AI plans, are building a diversified stream of recurring revenue that makes the business less dependent on advertising. Confidence from major investors, including Berkshire Hathaway's multi-billion-dollar commitment, further underscores the belief that Alphabet is positioned to lead in the AI-driven era. Together, these catalysts highlight why many analysts see Alphabet not just as a dominant tech company today, but as one of the key architects of the digital future. Despite its impressive financial strength, Alphabet faces several headwinds that could restrain its stock performance going forward. Competition in artificial intelligence is intensifying, with rivals like Microsoft and Amazon aggressively pushing their own platforms, raising questions about whether Alphabet can maintain its dominance in search and advertising. Regulators in the United States and Europe continue to scrutinize its advertising business, with the possibility of forced divestitures that could weaken profitability. At the same time, Alphabet's massive spending on AI infrastructure, while necessary to stay ahead, creates pressure on margins and free cash flow, leaving investors wary about sustainability. Technical signals have also pointed to weaker momentum in the stock, suggesting that enthusiasm may be tempered unless new catalysts emerge. Together, these challenges highlight that Alphabet's path forward, while promising, is not without significant risks. Now we are looking at Alphabet's stock valuation, where its fair value is estimated around $313. At present, Alphabet's share price is trading above that fair value. The stock has continued to strengthen following the release of its Q1 2026 financial results, reflecting investor confidence in both its performance and its strong growth prospects moving forward. Alphabet's Q1 2026 results delivered a powerful message to the market. Revenue growth above expectations, net income nearly doubling, and Google Cloud's explosive momentum all reinforce the company's position as a leader in the AI era. The stock's continued strength after earnings reflects investor confidence not only in Alphabet's financial performance but also in its long-term growth prospects. Positive catalysts such as Gemini adoption, subscription expansion, and custom chip innovation highlight why investors remain bullish. At the same time, risks from regulatory scrutiny, intensifying competition, and heavy capital spending remind us that growth comes with challenges. For investors, Alphabet represents a balance of extraordinary opportunity and calculated risk, positioning the company as one of the most influential forces shaping the digital future. This content is for educational purposes only and does not represent financial advice. Thank you for watching, and don't forget to like and subscribe for more insights.